Millions of people may soon lose their unemployment benefits. Here we go again. You came here for the truth. Today we are going to look at a very serious issue. Previously, I talked about the debt ceiling. I talked about the moratoriums on evictions. I talked about so many people today that are suffering, that are right at that poverty line and unable to make ends meet. And what does it mean for them in the future? Well, the first thing we're going to talk about is, of course, unemployment. Many factors here around that, but I want to show you some new statistics. The second thing is the economic slowdown. In line with all of what we have seen, that seems to be in our near future. So I want to cover some stats on that. And the third thing is shrinkflation. Shrinkflation is real, let me tell you, and I'll give you some more data on that as well. A lot to cover here, so let's go. Make sure you stick with me until the end. We're going to talk about shrinkflation right at the end there. So look at the reverse repo operations of the day. We didn't get to the 1 trillion, but it's at $921 billion this time around. We'll see where that goes. This is key here to really start the video, and it's something that you should be keeping in mind, an investor or just somebody who is concerned about the future. As the economy hits its peak, stock market gains could be harder to come by. And that is very true. Despite the fact that these are disconnected, there are elements that do tie in. Wall Street is increasingly talking about peak growth in both the economy and corporate earnings. Inflation is running at 30-year highs, while growth lately has been solid, but a bit disappointing. And they're referring, of course, to the GDP, which we all know how manipulated that was. Brimming investor optimism is flashing warning signs, according to Bank of America. Big key information right there. I don't know if they have the chart in this one. I do have a few charts that I want to show you. And of course, you can see. Just look at this quote. We have found Wall Street's bullishness on stocks to be a reliable contrarian indicator. I think that's really good to hear because, often you just do not get that type of information, but it's good to hear. And the reason that it is good to hear is because there are particular indicators that you can use as an individual if you're, for example, swing trading, to make this something that you're going to take advantage of. There's always a rebalancing of portfolios, and for the wise, for the prudent, they could seriously be doing something for themselves with this. There's an unemployment cliff coming. More than 7.5 million people may fall off. Now, just like the rent moratoriums, some areas could be pushing this back. There could be increases coming from other directions to kind of even it all out, but who knows? We only know when the time comes. Federal unemployment programs have paid jobless benefits since March 2020. They're supposed to end on September 6th. It doesn't appear that Congress will extend them again. Roughly 7.5 million people will lose their benefits entirely at that time. That's huge. Now you can look at some states that have gotten rid of theirs, but of course we will see what happens with the federal side. This is huge. Absolutely huge. We need jobs. We need manufacturing. We need any type of job, in fact, that is going to be paying a decent salary. At the same time, though, more important than the salary is the cost of goods need to remain at a reasonable level. Look at the price of real estate. Look at the price of commodities, which I'll show you in just a second. Look at how everything is on that incline, and wages simply are nowhere to be found. U.S. manufacturing growth cooling, bottlenecks starting to abate. That's a good thing about the bottlenecks. We'll see what happens with the prices. U.S. manufacturing activity grew at a slower pace in July for the second straight month as raw materials shortages persisted, though there are signs of some easing in the supply chain bottlenecks. You could see the ISM PMI, which had peaked out right here just a few months ago and has come down since. It's still elevated, there's no doubt about that. And if I show you, just bring out the highlighter to give you an idea, this right here is the 50 line, and that 50 line above the 50 is essentially bullish and below 50 is bearish, or should you say it, moving in positive territory and moving in the right direction if it's there. But look, yes, obviously you had this big dip down during early 2020, right? But I was covering this the entire time. This is the start of 2018. Look at what happened here into 2019. That was already on a decline. It was down. It was coming down. And why? This time frame right in here, 2018, corresponds directly with the reduction in central bank assets. But people don't want to hear that. My goodness. No, Money GPS. Don't do it. All right. Commodity index, the CRB commodity index, it is accelerating beyond anything we have seen before. I mean, yes, you have had certain commodities that have come down. Very clear. Look at lumber. It's down from its high. It has come up from its bottom though. Lumber at 626 currently as I record this video. Crude oil is above 70. So you can see that things have accelerated. There's no doubt about it. But where will they go from here? Goldman Sachs believes this is early in the commodity super cycle. So just imagine where the prices can go. US construction spending is just barely up right now. If I pull this back to the 5-year, you could see, of course, it's always fluctuating, but I just wanted to show you that this is a real, true, important factor when it comes to it. I'm just using this as a prop to talk about the fact that we need to see things being built, but of course, we don't want bridges to nowhere. We want to get people working. We want to fix what we have. We don't need this unnecessary spending in many cases. And that's unfortunate. So look, I'm going to talk about the Money GPS insights right now. Let's get deep into it. Number one, in the next month, we could have millions of people losing their benefits. Number two, this will have a direct impact on economic growth. There is no way to deny it. We have seen the stimulus as it moves through the system being directly correlated. So this, of course, would be another blow. Number three, investors, listen up. The stock markets today are relying entirely on the Federal Reserve's actions to continue, yet there are some warning signs that QE could be reduced. Take a look at this article here. Just one quick point. About 90,000 restaurants and bars have shut down over the last year and a half. It's really sad to know. I mean, I'm sure in your case, in your city, in your town, there used to be a mom and pop shop around the corner and you tried to support them. You went by, you bought some things if they were open, and unfortunately they had to shut their doors. This happens to so many people and many lives are affected dramatically by it. Look at this. I find this very unusual. IMF nations approve a record $650 billion to have this aid come in. I mean, it's a year and a half too late if they wanted to make it seem this way, that they were trying to help. Special drawing rights, SDRs, allocation considered since early 2020. I did talk about it, but I just kind of forgot about it. Nothing really happened, but here you go. The richer nations are reallocating some reserves to poorer ones. What exactly do they intend on doing? I mean, it's just so ridiculous. It's so strange when the IMF does anything. I find it very, very unusual. I can't make sense of it. Not that the help isn't good, but it's so far into this now. Why wasn't that done before? And what exactly are you trying to do? All of these different governments have gone into debt and deficits. Look, Canada, in terms of, relation to the GDP, shouldn't they get some of it? I mean, is that how you're quantifying this? What measurements are they using? I mean, it really doesn't make any sense. There's no growth. The emerging markets have the growth, if that's what you're looking at. The developed economies, they have no growth coming for the next decade, and that is based on so many different factors. I've talked about this a million times. What is the key here, though? We are seeing inflation across the board. Mention of inflation jumped nearly 1,100% year over year to a record high. Look at that. This is S&P 500 companies' mentions of inflation per earnings call. Going back to 2003, haven't seen anything like it, way beyond what we saw back in 2008. Bank of America providing these stats as well as this one and the next, I believe. Supply chain and price mentions rose to a record high as well. Off the charts, okay? Then you have this. Business conditions indicate a weaker business, just essentially just showing you that they have less confidence, okay? That's what they're saying. And on the right-hand side, companies are less optimistic than they were in the prior 2 quarters. Of course, they know that things are looking wacky. All right, shrinkflation. Check this out. Why everything from tuna cans to toilet paper is shrinking, but prices are not. You can definitely check out the article, but I just found this interesting how they say, if you can't read the font, Charmin size difference. Top from Ralph's, bottom from Costco. And they actually did a measurement and traced out the difference. You see? They reduced the size of the toilet paper. Why? So that the product can stay the same price. Oh, there's no inflation where I am. No inflation. GPS, you're a liar. But here, shrinkflation is that sneaky way to get it to happen. I don't know of any big business, even small business, that hasn't pushed up their prices. Okay, you can see a few examples, but stop pigeonholing it. Come on. Every big business is starting to talk about it, whether it's Procter & Gamble, Unilever, all these other businesses that are there, that these mega conglomerates that own everything, basically, they're saying we're not only have we increased prices, we're going to continue to do that. Okay, so if you're interested, definitely check it out. But you can see it. There's some information in here related to the shrinkflation. I just wanted to bring that up, bring those points up. World's biggest pension fund cuts U.S. bond weighting by record. This is Japan. Okay, Japan's GPIF reduced allocation to 35% in fiscal 2020 from 47%. Money flowed instead into bonds from France, Italy, and Germany. Can you believe this? Going away from the U.S. and into France, Italy, and Germany. Something's going on here, that's for sure. Now, they still got 35%, still a big number, but that right there is something definitely of note. I'm going to leave it there. I don't have any more points to say. I just kind of like to update things as I can. I want you to know that if you want the deepest intel, if you want to be able to get this directly from me, the only way to do that is to get on the insiders, because the insiders is my way to get to you. Your email, you put it in there and I will email you the video of the day. Soon, this is going to include like a newsletter, essentially daily information that will be unavailable anywhere else. So I hope that you will get on there. It is totally free, of course, and it is available at this card up here, which you can click, or at themoneygps.com. You can support the channel simply by giving a thumbs up. I do appreciate that. Thank you very much. And don't forget to check me out on Instagram and Twitter and Facebook and LinkedIn. All of that is so important because I'm actually giving out information that's funny so that you can share that with your friends and family, coworkers, and so on that aren't really into this stuff. So it'll give you a way to share that. I think it'll be important for you. I'm working really hard to create that content. So definitely check me out and subscribe on there as well. If you haven't seen this video already, you definitely want to take a look. Click it and I'll see you there.